Today, DFA's statement on monetary policy. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. The RBA published their statement on monetary policy today, and indeed Philip Lowe not only appeared before the House Economics Committee today, but also gave a speech earlier in the week. And his main thematic was that things are actually pretty good. There's a few clouds on the horizon, but nevertheless, all is well with the Australian economy. We're on the gentle upswing, and as we discussed the other day, that means that wages growth will happen, it means that inflation will improve, and it means that growth will also improve. Well, I have to say that I have a slightly different perspective, and I thought today I would publish my own statement on monetary policy based on some recent comments that I've made and also recent slides that I've put together. So this show is a summation of my current thoughts with regard to the economics and the banking system and specifically housing finance. And I have to say that I am probably a little less positive than the RBA. And to start the conversation, let's look at what the RBA has said. No real change from their forecasts. They're still thinking that the unemployment rate will continue to slide ahead, that effectively growth will still be quite strong next year and the year after. And, a little bit of recognition that with some uncertainty in the numbers, but nevertheless, extremely bullish, remarkably bullish, actually. And interestingly, he did say, look, a lot of the issues with regard to fiscal and other strategies that might be thought about with regard to the economy is not my bailiwick. I'm only worrying about the things I can control. So that was quite interesting, too, in terms of limiting his scope of influence. And it's quite fascinating when you remember that, of course, the Council of Financial Regulators has Treasury, the Reserve Bank, APRA and ASIC all sitting around the table. So it's sort of, interesting division of responsibility when they all sit in one room. If you go back 4 or 5 years, both the RBA and indeed Treasury have been over-optimistic on wages growth, over-optimistic on overall growth, and forecasting unemployment lower than it actually turns out to be. So they've got a consistent track record. And in fact, the next slide, which was from MyEFO, makes that point. So the Treasury downgraded its outlook for future wages growth again. But if you go back the last 4 or 5 years, they keep over forecasting wages growth and then they have to forecast it down again. So they've got a very bad track record of actually translating, if you like, an aspiration into reality. And the other point about MyEFO, which I just want to sort of focus on for a second, is that the real spending per person from a government spending perspective is actually going to go backwards over the next 4 years, according to MyEFO. That's remarkable. That's never been seen before. So the per capita growth is actually negative because high migration. So the number of people in the country going up, but in fact they're not spending as much per person as perhaps they were previously. That's a bad number, I think, so we should watch that closely. They were looking for a surplus of 7.1. It's down to 5. It's probably going to be somewhat below that. And I think you've got to bear in mind a few of the moving parts, right? Because we know, for example, and they said it in MyEFO, for every $10 down on the iron ore price, they lose about 3.3 billion out of the bottom line, right? So, $10 down, you lose half of it. And we also know, of course, that the bushfires and the trade impact of the coronavirus, the fact that we haven't got students now coming back into Australia to complete their studies that they were expecting to, and if tourism is way off, those are factors which have a significant impact. So my suspicion is that the December number will only be hit slightly, but it'll be the first quarter. But then, of course, the question is what happens after that? And then that really becomes a question of, well, is coronavirus like SARS? Because SARS was a short, sharp hit and then a significant recovery. Some people are now suggesting that the infection rates and the growth rates of this particular one look more like flu rather than SARS, in which case it could go on for a lot longer. And of course, China is now significantly more connected to the global economy relative to where it was back in SARS time. So, for example, Hyundai has actually stopped production on some of its cars because it can't get parts from China. Right, so we're starting to see some of the trade fallout even now. So this is really something to watch, because if this does continue to escalate, this could be a big deal. On the other hand, China is putting a lot of stimulation in through the Central Bank of China, the People's Bank. So what they're doing is big QE to try and keep everything going at the moment. And that's interesting because they've said it's more to do with social cohesion and protecting society than it is just about the economics, which I thought was interesting in its own right. But the amount of activity is amazing. So just watch this space. We don't know yet precisely how this is going to play out, but it could be big. Final point to make is that the $2 billion that they're going to spend on bushfire relief, that's quite big stimulus in Australia, right? So we're already seeing effectively the government walking away from its surplus. And they've said several times recently, look, the surplus isn't an end in itself. It's good if we can get there, but actually we've got to do the right thing. So I think their language has changed, and I would expect to see perhaps more intervention as we go ahead, particularly if in fact we get more negativity coming out of the coronavirus sphere. So watch this space. This is probably one of the root cause issues that we've got in Australia, right? That our ability to spend is really being compressed thanks to flat wages growth, cost of living rising, all the other things. And despite the fact that interest rates are a little bit lower now, we are actually in a less good position than almost all other countries on that list. And that's OECD data. So it really just underscores it. And, we're going backwards. We had a significant drop in seasonally adjusted retail sales for December. The trend is still at 0.3%, so it's sort of running along. But there was a significant drop in seasonal terms. And what happened, I think, is people spent quite big for the sales around Black Friday in November, and then spent considerably less in December, and then perhaps also spent less in December because of the bushfires. So the retail numbers are looking pretty wobbly, and that's why we've seen, quite a few now retail stores falling over, from Jeans West and a few others as well. We're going to see more of this, not just the big brands, but also small local retailers also under the gun too, because households don't have the money to spend. And the chart on disposable income underscores that. So this is a big deal. Still got high mortgage stress. 1.1 million households in some degree of cash flow difficulty. And some people say, well, hang on, how can that be? Because interest rates are a lot lower now. Surely it should be going down. But the point is, you've got to look holistically at household budgets, right? You've got to look at their mortgage repayments, but you've also got to look at the other costs of living that they're actually experiencing at the moment. And there were very significant rises in childcare costs, healthcare costs, and education costs, and even food prices, particularly fresh food, because of the drought. And so what we're seeing is that the pressure on household budgets are still rising. And, we've discussed CPI many times. It probably understates the reality. But the reality from a cash flow perspective is that more households are struggling with trying to make those mortgage repayments and manage everything else. And they can put more on credit cards. They can, dip into deposits if they've got them. But at some point, the chickens come home to roost. So I'm still expecting the stress to translate into higher defaults later. And the banks, of course, will have a great difficulty in passing on any more, simply because of the fact that the margins between deposits and loans are really under compression now. And so that means that even if the Reserve Bank did drop the cash rate again, there's no guarantee that would get passed on. What's happening at the moment is that banks are offering really, really cheap loans to new customers to try and attract them in, but your existing loan, you probably won't get much of the benefit. And that's what's happening at the moment. So whilst rates are lower, not everybody is enjoying the benefits of those really low rates. We are actually generating a lot of jobs. We've got high migration. So migration is one of the factors here, which is one of the reasons why the employment rate is where it is. And of course, wages growth being what it is too. But the interesting thing about this chart is that the participation rate actually dropped in December. So that says that there's a slightly smaller proportion of people who want to actually work in the market. And that could either be because they've taken some holiday over the Christmas New Year period, or they actually have decided it's too hard to find a job. So that's the first point. The second is that the rate came down a little, but 5.1. But, it's still a lot higher than what the Reserve Bank thought it should be at 4.5% before you start seeing wages grow. So there's little evidence that we're going to see much in the terms of wages improvement in any time soon. And he made that point, actually, in his speech yesterday. The other point, though, is underutilization. So this is people who are actually in work but aren't actually working as much of the time as they want to. And we're seeing huge amounts of underutilization in the market. So that's the real critical one to watch, because the reason that many people aren't getting as much income as they want isn't because they're not working at all. It's just that they're not working for as long or with much overtime as they like. And so underutilization is a critical figure to watch. And you put those two together and you realize that we've got significant structural issues in the unemployment numbers. And by the way, younger people are particularly exposed to underemployment at the moment, which I'm concerned about. And in fact, as we'll see in a couple of slides later, they're banking on home prices being the trigger to create the wealth effect, to encourage people to spend more, to then effectively create more economic growth that will actually lift jobs. That's the sort of the logic that they're, but it's flawed, I think, frankly, it's absolutely flawed. So this is from Roy Morgan. So the business sentiment is as low as it's been for a long, long time. And the household consumer sentiment is also significantly down. So the proportion who think that next year, in other words, 2020 will be worse, has actually risen significantly, whereas those who actually think it could be better is gone the other way. So effectively what we've got now is more people saying, oh, this is looking pretty rocky. And of course, low levels of confidence, be business, they don't invest. And we're seeing business investment continuing to fall. And for consumers, they're going to start paying down loans more. They're going to actually reduce their exposure and they're going to spend less at the shops. And that's what we're seeing at the moment. So what happens is banks in a low interest rate environment will tend to lend less rather than more because they can't make the sufficient margin between deposits and loans. But what they will do is they will go into much more speculative areas. For example, trading either on their own account, derivatives, or trying to effectively get into the trading sector of the marketplace for more affluent clients, which is what we saw in the US bank results this time around. So a lot of the major banks over in the US reported quite good results, but the composition of that was very different. Lending was less powerful relative to the wealth management and trading areas. And so that, of course, increases risk because these trading activities are significantly more risky relative to lending mortgages. And so that means that the risk profile of many banks will actually get more extreme as rates drop. Philip Lowe was saying, well, dwelling approvals and building activity looks as though it's going to recover. Well, yeah, maybe. It's not looking great at the moment. The most recent data showed a little uptick in unit approvals. But if you look at the details there, last month there was a significant high-rise approval in Sydney that had a large number of dwellings. This time it's one particular high-rise approval in Melbourne. But the underlying trends are still relatively weak and way down from where they were. So we have a lot of work to do to get building approvals and dwelling construction back to wherever it was. I think this is still a sector that's actually in negative territory rather than positive territory. And I'm still seeing in my own surveys more building and construction traders, for example, saying we haven't got work. So I think this is something to watch again, because for me, there's very little light at the end of the construction tunnel at the moment. 220,000 or thereabouts coming in, so there's plenty more supply even before we build more. Well, just to say that the data that's just come out today, and it's actually dropped further, it's now 12% down from its peak. This is the previous month. So we're seeing the same trends, it's just more of the same. But interestingly, again, it's the SUVs that are growing, everything else is shrinking. Just to say that the trade numbers also came out today, and so the trade numbers to December actually weren't too bad. They came away just slightly. Imports rose a little. But although the iron ore was pretty good and the price was quite a lot higher than it is now, there was less throughput for coal, which I think could be an interesting leading indicator to watch, because we're starting to see now some countries turn off demand for coal, which could be interesting. And we also saw a significant fall in the grains exports, and that was partly driven by the drought. So we've got some moving parts in our trade numbers that again suggest that net it's looking not too great. My calculation is on the December numbers, we're going to see a contribution to growth of 0.1%. So it's a very small incremental increase in terms of the GDP number based on the whole export-import phenomenon. Yeah, and BlackRock, one of the big investment managers around the world, has basically said they're going to look much more carefully at companies' environmental credentials as part of their investment decisions, and others will follow. The CoreLogic numbers are still looking very, very positive, although I would make the point, as I've shown here, that the rate of growth is easing. Right, so if you look at the yellow line there on the right hand side, so although prices are still rising in most centres, although maybe not Perth. Now, there are other data sets that suggest that, in fact, price rises have been much more disparate across various locations. So there are some postcodes where they're higher, some places where they're lower. But, the bottom line is this. Are we really willing and able to stoke the household debt even higher with low interest rates, of course, just to try and keep home prices high, to try and encourage people to borrow more, just so that we can get more activity, because that's what the plan is at the moment, right? And the first owner grants, which are now available, report came out just very recently, about half of the first 10,000 now have been basically allocated, most were through the major banks. The smaller banks are now starting to lend, so there's another 5,000 to go. So they'll probably be exhausted by the end of February. And then we've got another 10,000 from July onwards. So we've got this stimulus for first home buyers to try and get them into the market at the time when incomes are flat, when in fact we know that prices are doing weird things. So there's a whole bunch of uncertainties here, and I think we should be very cautious about pegging the future of the economy on more home price growth. It's a one-trick pony, unfortunately, and my concern is that we are actually burdening households with a lot of debt. So a lot of those first home buyers will have 95% mortgages, and they'll hope that their prices will go up, so they create some equity. But if there's a 5% fall, so for example, if the coronavirus creates global growth problems and prices fall, they could lose that 5% and then basically be nowhere, and that's a real concern. So this is the 3-month aggregates from the Reserve Bank. We don't know the flows yet. That's coming out in a few days. But yeah, it's quite interesting. So the over the 3-month rolling, it's 1.4% for owner-occupied housing. So that's up. For investment, though, it's actually down a bit. So we're not seeing property investors coming back in particularly strongly at all. And in fact, everything I'm seeing with regard to rentals being very, very flat at the moment, real no growth there, and with capital gains really not around very much. Property investors are still on the sides, and of course, international investors won't come here at the moment with the bushfires and with the coronavirus. So that's the other point to make. So overall, credit for housing rose 0.8% over the 3 months, which is a slight uptick, but not huge. But the other interesting point is that personal credit has started to slow less. And that suggests to me that some people are now beginning to get running out of runway with regard to their cash flow. So they're having to basically get more credit to keep themselves through. But the other one to highlight is business credit growth, which is very low. And you can see it's slid over the last 2 or 3 months. And this really concerns me because this goes directly back to poor confidence in business. They're not willing to invest. And the trouble is, of course, that if in fact the banks are lending mortgages to people because they, want to get first-time home buyers in the marketplace, that's not real growth. What we really need is business investment to fire. So we should be seeing the credit growth moving up if we're really going to start seeing the economy turn around. So nothing in these numbers gives me any comfort that in fact we're not facing into more issues with regard to debt ahead. Phil Loeb showed this chart yesterday in his speech, the one on the left-hand side, and he made the point that the proportion of repayments on, if you like, repaying interest has come down as rates have come down, which is right, and more people are repaying more of capital. In some people's case, they're paying more than the minimum to reduce their exposure to debt. Now, they're doing that because essentially they're concerned about the future, their confidence levels are low, and if you don't know quite whether your job is secure or not and whether your income is secure, then you will want to get out of debt rather than putting more debt on. So that's one of the reasons why repayments are more accelerated. That's the reason why the total amount of credit in the system's not growing very much. But the other one is that the data also shows that the interest payments relative to income have definitely come down. So the interest rate cuts are having some impact, but they're not actually translating at the moment into people spending more at the shops, right? Any spare money, whether it be the tax breaks or whether it be the interest rate cuts, are going into repaying debt, which I think is a really interesting phenomenon. Because if they just mess with the tax rates, again, I think the people with big mortgages and an income will just pay it down, and that's not going to help. You need more money coming into the economy to turn the economy over, to create growth. And at the moment, I don't see much evidence of that. It is remarkable what's going on at the moment. So a lot of the big banks in the US are basically going to the Fed and saying, we need help with liquidity, right? For the reasons that we've just touched on, because of trading. And they're also wanting the capital ratios to be reduced to give them more flexibility, right? So all of the buttressing that's been done since the global financial crisis to try and protect the banking system is actually just being, turns on its head at the moment. And the point is, we've got more derivatives exposure than we've ever had, and a lot of it's centered around some of these large banks, including Deutsche Bank in Europe. And so there's a need to keep the liquidity flows up there flowing. Otherwise, the banking system's going to freeze up again. And the point I wanted to make is that, of course, China is now putting huge liquidity into their markets. They're using repos to do that as well. So essentially, we've got this continuous cycle now of central banks putting more funds into the system to support liquidity, to essentially keep the banking system going. And in fact, I would argue that the banking system in the US, in China, in Europe, and to an extent even in Australia, is on life support thanks to this massive amount of liquidity. This is dumb, because what we're doing is we're just inflating asset prices and essentially creating a bigger debt pool for later. This is not productive, and it's not working. If you look at what's happening with regard to Europe, the growth rates there are very low, and even with negative interest rates. And so this whole keep lending, keep getting bigger, keep inflating the balance sheet, despite what the Fed said. So the Fed said, well, we want to sort of taper this off over the next few months. I have my doubts they can do that, particularly now with the risks around the coronavirus too. So this, for me, is one of the underlying stupid factors in the behind the scenes, as it were, that's creating the economic environment that we've got. And unfortunately, it's really degrading real incomes for real households, and many people are not feeling any of the benefit of this stuff. The financial system might look fine, but real people, no. The international thinking around central banks, they all get together, and they all sort of share the same common thinking. That's the problem. This groupthink around central bankers, I think, is part of the issue. It's not part of the solution. And unfortunately, they're all looking at it the same way. And therefore, the chances are that we will end up with negative interest rates here. But the last slide, right, which is the one I just wanted to end on today, what would happen if, in fact, negative interest rates are here to stay? And this is analysis just published by the Bank of England. It's actually in one of their working papers, looking at the long-term trends of interest rates, right? And basically their position is, if you start in 1310 and go through to 2018, the trend has been for rates to go down, 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 down. And essentially, irrespective of monetary policy, irrespective of what central banks have done, irrespective of the political structures they've worked within, interest rates are continuing to go lower. And basically, the summation of their argument is, we're going to have negative interest rates, and we're going to be stuck in negative interest rates because the long-term megatrend is into negative territory. And what that says is, whatever the Reserve Bank or whatever the Fed is thinking of doing, it's not going to be effective. So we're going to end up with negative rates. And of course, if that is true, then the whole foundation of the way that finance works is in question. But the point is, of course, that they are now trapped into this negative cycle, right? So my argument is, if the Bank of England is right on their overall analysis here, then effectively we're backed into a one-way corner into negative interest rates, but we'll never get out of them. And that basically means that it's continuous QE, continuous printing, continuing asset inflation until what happens? Well, until we get to the point where the whole thing implodes. This is, very worrying, because what this says is that negative interest rates is not just a sort of a short-term blip and then we'll come back to, 1 or 2% again. This says the mega trends suggest that this could be going negative and more negative into the future. And that would be a huge deal if that was true. The question is, how long can they go on doing it for, right? Because the resources that the Chinese banks have or the Fed has is huge, right? So they can still do it for a lot longer. So I keep saying, don't assume this is going to blow up in 6 months. This could go on for 5, 10 years. Remember that there's a lot of uncertainty out there at the moment. So a lot of the predictions that people are making are based off hot air, right? So, don't buy the story that there's no impact of coronavirus or bushfires, or that everything's doom and gloom. Nobody knows. Just keep watching for the data, and we'll update as real data comes through, and I'll incorporate my models. But the level of uncertainty is probably as high as it's ever been at the moment. So in closing, I guess it's worth saying that time will tell whether the RBA is closer to the truth, or indeed DFA is closer to the truth. But I have to say that the headwinds to me look quite a lot stronger than through the RBA's rose-tinted specs. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.